In the previous video, we were discussing about fund-based financial services. We know the financial services are divided into traditional activities as well as modern activities. And in the traditional activities, we saw that it is further classified into fund-based activities as well as non-fund-based activities. So, some of the fund based activities were explained in the previous class. Today, we'll be discussing in detail about one fund based activity, which is lease financing. So, what is lease? What do you understand by the term lease? Lease means taking an asset for rent. Instead of purchasing an asset, you're going to rent it and use it in your business. See, sometimes we might be having lack of funds. Okay, we might not have sufficient funds to invest in a particular asset, but we do need that asset in our business to carry on our business activities. So the another option, in case you do not have sufficient funds to purchase an asset, is to take it for lease or to rent it from someone. Or there might be a situation where you're in an industry which keeps changing. That is, high technology is used in your type of industry. If you're a person who is using maybe computer equipments or cameras, it keeps on changing, right? New versions keeps on coming up, updated technology is being introduced. So it is always wise to just rent the equipment and use it, so that after the rent period is completed, you could maybe rent out a more latest technology device from another rental company. So leasing is a good option in case the industry that you are involved in has got a use of high technology. Technology keeps on changing, so it's best to just rent the equipment than purchase the equipment. See, so what is leasing? Lease is a contract whereby the owner of an asset, the owner or the person who holds the asset, is known as the lessor, grants to another person, who is known as the lessee, the exclusive right to use the asset, usually for an agreed period of time, in return for the payment of rent. So there are some features that need to be highlighted in this definition. There are two parties. There's the lessor and the lessee. The lessor is the owner of the asset. The lessee is the person who takes it on rent. So the lessor rents out the asset to the lessee, okay, for use of the lessee for a specified period of time. The lease rental is for a period of time, after which the asset has to be returned back to the lessor. And during the period in which the lessee is utilizing that asset, he has to pay a rent, which is known as the lease rentals. Okay, so this definition is given by James C. Van Horn. So you can also refer other definitions. I've just given one definition. I hope the concept is clear. Instead of purchasing an asset, you will opt to rent it. That is known as lease financing. So I have again highlighted the features. See, there are two parties involved in lease financing, the lessor and the lessee. Now, the lessor can be a company, a cooperative society, a partnership firm, or an individual who is involved in manufacturing or related activities. So it could be any person who is the owner of a particular asset. Now, lessee is the person who takes the asset on rent. Suppose you are someone who is involved in the film industry. Okay, so you have a company, a film making company, and you need cameras and equipments. Now you know the camera technology keeps on changing, latest versions keeps coming up. So instead of purchasing those equipments, they will opt to rent it. Or you could be a doctor. Okay, you are owning a hospital, you're the doctor there, you need the latest equipments for treating your patients. So the equipments also keep on changing year after year. Latest equipments keeps coming into the industry. So in that case also you could rent out the equipment. So if you're a lessee, you could be anyone in any field, but you're the person who is taking it on rent. Now the lessor retains the ownership of the asset. The lessor will always hold the ownership of the asset. Lessee will have the possession of goods. He is the one who is holding the goods and using it. I mean the asset. He is holding the asset and using it. Now, in return for using the asset, the lessee will pay to the lessor lease rentals at periodic intervals. Now, there's a lease agreement between the lessor and lessee once they have agreed to enter into a business transaction. So, there's something called the lease agreement. And once the lease agreement is signed, the contract is sealed. So, let's see what are the contents of the lease agreement. The lease agreement will specify the basic lease period during which the asset will be allowed to be used by the lessee. So what is the period for which they are entering into the contract? Is it a short period contract, or is it a long period contract? Is it going to be for just 6 months or 5 years or 50 years or 100 years? So the lease period will be mentioned in the lease agreement. What is the timing and amount of periodic rental payments? I said you have to make rent payments at periodic intervals. So will you be paying the rent every month, or once in 6 months, or once a year? Usually it's on a monthly basis. So what is the timing and what is the amount of rent that you are going to pay? If you are going, whether it is going to be fixed payment or will there be changes? Usually it is fixed. The rent amount will be fixed. The details of any option to renew the lease or to purchase the asset at the end of the period. Now, there are some lease agreements where the lessee is allowed to purchase the asset at the end of the lease period. Okay, so you do not have funds right now to purchase the asset. So you're going to take it for lease or you're going to rent it. Now, once you have used it for a period of 5 years, you have got a good business in your hand, you have got sufficient funds. So you decide to purchase that asset. In that case, when the rental period or the lease period ends, the lessee can ask for purchasing the asset from the lessor. So if there's any option like that, that should be specified in the lease agreement. And also details about renewing the lease. That is after the end of the 5 years. Suppose it was a lease for 5 years. At the end of 5 years, you would like to again enter into a lease agreement with the same person, with the same lessor. So you're going to renew that agreement for a further 3 years or 5 years. So details about that should also be mentioned in your lease agreement. What are your options for renewal? The details regarding payment of cost of maintenance, repairs, tax, insurance, other expenses. See, when you purchase an asset, there are other related expenses that comes along with the asset. Who is going to pay for the maintenance of the asset? Who is going to pay taxes? Who is going to pay insurance? If there is any repair work that is required, then who's going to pay for the repair works? Sometimes the expenses are borne by the lessor, sometimes it is borne by the lessee, depending upon the type of lease. So that should be mentioned clearly in your lease agreement to avoid future conflicts. So lease agreement contains all the details of the lease. What are the different types of lease? Okay, the first one is financial lease, operating lease. These two are the most important leases. Financial lease, operating lease, sale and lease back, cross-border lease, and leverage lease. I'll be explaining in detail what is financial lease and operating lease. Before that, I'll just brief through what are the other three types of leases. Okay, so the third one is sale and lease back. Sale and lease back means suppose you already bought the assets, but now you feel like you should not have invested so much and locked up your funds in that particular asset. You need funds urgently, but at the same time, you need that asset also in your business. So you have got a good option in sale and lease back. That is, you will sell the asset which you already purchased and then take that same asset for rent from the buyer or the lessor. So you have got a particular machine in your company. It is worth rupees 5 lakhs. You're going to sell it, you'll get the sales price. And after selling that asset, instead of transferring the possession to the new owner, you will enter into an agreement with that person to take that asset for rent and use it in your business. So you're selling your asset, you're not handing over the possession of the asset, you're only handing over the ownership. You will get the sales price, then you're going to use that asset for rent in your business. You're going to sell it and then lease it back from the buyer. That is the sale and lease back. Next one is cross-border lease. This is nothing but the lessor and the lessee will be located in two different countries. The country of domicile is different for the lessor and the lessee. So it is an international lease. It's known as cross-border lease. Leverage lease. Leverage lease is where the lessor is not going to contribute 100% of the funds to purchase the asset. Lessor is a person who is owning the asset and renting it out. So instead of investing in that particular asset with his own funds, he's going to borrow some funds and then invest it. So 20% or 30% of investment will be made by this person, and the remaining investment on the asset will be made by some other institution, financial institution, or a group of persons, or a single person. And then for that 80% of investment, interest will be paid by the lessor. Okay, so the lessor is borrowing the funds to purchase the asset. Then after purchasing that asset, he is renting it out to someone, and the lease rentals are there, as well as the asset that he purchased will also be mortgaged to the person who contributed 80%. I hope I'm not confusing you all. It's very simple. If you are purchasing a particular machine, you'll be contributing 20% of the funds from your own savings. You will be borrowing 80% of the funds. You buy that asset. Instead of using it, you will be leasing it out or renting it out to someone else. That is known as leverage lease. You're buying on debt and then you're leasing it out. That is all. Just keep that in mind. The important two types of financial lease and operating lease. I just want you to be familiar with the other three terms, but what is important is you understand what is financial lease and operating lease. Okay, so coming to what is financial lease. It is also known as capital lease, long-term lease, net lease, and close lease. These are the other names of financial lease. Usually it is known as financial lease itself. Even in the question paper, it will come as what is financial lease. Just be familiar with the other terms. Now, in financial lease, it is a long-term lease. Usually, the person who's taking it on rent is going to use it during the whole economic life period of that asset. If that asset is going to function for 10 years or 15 years, then the person who's taking it on rent intends to keep it till the end of the life of the asset. So the lessee selects the equipment. He will decide the price and terms of sale and arranges with the leasing company to buy it. The lessee will be the person who is using the asset. He will pay the maintenance cost. He will pay the insurance expenses. He will also make use of the after sale services and the warranty which is available along with the asset. So it's almost like owning it. It's like installment loan where you're going to pay off the cost of the entire asset over a long period of time in installment basis. Now, the lessee bears the risk of obsolescence. What is obsolescence? Obsolescence is nothing but the chance of being outdated. Okay, the equipment that you purchase might be outdated because latest technology keeps coming up. So, in case new technology keeps coming up in a financial lease, the lessee cannot back out from the agreement. He will have to stick on with the agreement till the end. So he will bear the risk of obsolescence. He will be paying rentals for the entire lease period. Now coming to what is operating lease. Operating lease is short term and it is used for only a particular period of time. It can be cancelled by both the lessor and lessee after giving a notice. So it is also known as service lease, short-term lease, or true lease. It is for a short period of time like 6 months or a year or a few years. Now lease is terminable by giving stipulated notice as I already explained. The maintenance cost and the risk of obsolescence in this case is borne by the lessor and not by the lessee. The person who owns the asset is the one who is going to bear the maintenance cost, the insurance cost, the tax payments, everything has to be met by the lessor himself. So what is the difference between financial lease and operating lease? Financial lease is like an installment loan where you're going to take possession of the asset and slowly pay off the rentals along with the interest. That is, the rentals um, will include an interest also. That is, if you are holding that asset for 15 years, at the end of 15 years, if you are going to calculate the actual amount that you paid as rentals, is going to come up to more than the actual cost of the asset. So it's like an installment loan. Whereas in case of operating lease, it is a rental agreement where you will be paying only the rent for the assets. The second difference is maintenance and taxes are paid by the lessee himself. The person who is borrowing the asset or the person who is taking it on rent will be in charge of paying for the repairs and the insurance charges. The lessor will not be bothered about all that. Whereas in operating lease, maintenance and taxes will be paid by the lessor who is the actual owner of the asset. The third difference is lessee bears risk of obsolescence. I said obsolescence is the risk of the technology getting outdated. That is, latest technologies will be introduced in that field, and the equipment that you are holding will be outdated. And then the value of that asset will go down. So the risk of obsolescence is borne by the lessee in case of financial lease, as well as in case of operating lease, the lessor will be bearing the risk of obsolescence. Financial lease is for a very long period of time. Usually, land, building, and all will be taken for financial lease. So, when you're leasing out a land to an institution, it will be leased out for a period of 50 years or 100 years. So, it's a very long period lease. Aircrafts are also taken for financial lease. But in case of operating lease, it is very short or medium term lending. So some office equipments or computer equipments or some vehicles and all will be given for operating lease. Now financial lease cannot be cancelled, whereas operating lease can be cancelled by either the lessor or the lessee. So these are the main points of difference between financial lease and operating lease. Now what are the advantages of leasing? The main advantage is that it enables the lessee to acquire the asset with a lower investment. If you're purchasing an asset, you will have to pay a lump sum amount in the beginning itself. But in case of leasing, you can use that asset at the same time. You just have to pay a certain amount as rent every month. So comparatively, it is a lower investment. Second advantage is it involves simple documentation. It is easier to take it for rent. If you're purchasing it, it involves more formalities. Third one is lease rentals paid by the lessee are deductible for computing taxable profits. If you're paying lease rentals, when you have to pay your income tax, you can claim it as a deduction. So it is a taxable, it is deductible for computing taxable profits. Provides finance without diluting the ownership or control of the business. If you're taking it for rent, you're not giving that particular asset is not having any sort of a mortgage. That is, if you're borrowing funds and then purchasing an asset, then in case you do not pay the interest on that borrowed fund, then the person who lent out the fund can come and take back that asset at any time. But when you're taking it for lease, you do not bear any sort of risk of such type. It does not dilute the ownership or control of the business. Now, it does not affect the debt raising capacity. That is, if you want to take loans, then the financial institution is not going to be bothered about how much assets you have taken on lease. They will only be bothered about your debt equity ratio. And taking on rent does not affect your debt equity ratio. So you could raise debt in future if you need. You could go for new loans. What are the disadvantages of leasing? See, when you're taking an asset on rent, you are not allowed to make any sort of alterations or modifications in that asset unless your lease agreement allows you to do so. So in most of the cases, alterations and modifications are not allowed. Now, normal business operations will get affected if the lessor is not willing to renew the lease. Suppose you have taken the asset for lease for a period of 5 years. At the end of the period, if the lessor is not willing to renew that asset, then you will be in a crisis. Cost of financing is generally higher than debt financing. Another disadvantage is that Sometimes the interest that you paid for borrowed funds might be less than the amount you pay as rentals for taking that asset on rent. So the cost of financing, lease financing, is going to be higher than debt financing. Now, certain tax benefits, incentives such as subsidy may not be available on leased equipments. You cannot claim for subsidies or incentives because you have taken it for rent and you are not the true owner. So the lessee will not be available, will not be allowed to make use of such benefits. Now, the value of real assets such as land and building may increase during the lease period. In such case, the lessee loses the advantage of a potential capital gain. When you're taking it on rent, you will be using that asset and returning it back to the lessor at the end of the lease period. So, in case the price of that asset has increased over the period of time, then the lessee cannot make use of the capital gains. These are the disadvantages of leasing.